Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Unfortunately, he's been dreading this all week. Richard Clarida with us now. His work at Columbia University, definitive on fancy economics called dynamic stochastic general equilibrium theory, holding court at the Fed as vice chairman. I'm not going to mince words, and frankly, Professor Clarida, are you still at Columbia?
I am.
You get a piece of chalk out every... See, the problem is Xavier Sally Martin wouldn't allow AI in the class. You'd allow AI in a freshman class to make the kids smarter, right?
I don't teach freshmen anymore, but...
Would you let AI in the class?
Well, not in the classroom, but when I teach, I assume the students are making reference to it, which is why I've actually put a focus on having in-class presentations.
There you go.
There you go. Old-fashioned Socratic dialogue.
I'm going to cut to the chase, Socratic dialogue. You saved Jerome Powell. Folks, I'm not going to mince words about it. It's called a dual-engine leadership model, and it was Clarida's vice chairman and a guy from Wall Street as chairman, and when he came in, you allowed him to relax and grow with your prodigious academic abilities. Does Chairman Warsh need a Clarida?
Well, that'll be his decision. I enjoyed my 4 years, that's for sure. But there are a lot of good people at the Fed, and I think that's a decision he'll make. He's got a very good vice chair right now, Phil Jefferson. But at some point there will be a vice chair vacancy.
Is that something that the committee, when he goes in front of these tough guys in the Hill, they can demand he have a vice chair of the academic skills of you?
Well, it's not clear that that's what would be on their wish list, but possibility, I suppose. I mean, they could request that, certainly.
Kevin Warsh has called for a new accord with the Treasury Department.
Yeah.
What does he mean by that?
Well, this is one of those things where this is very what they call in D.C. very big tent language. It means different things to different people. The one accord that we do know about, which is the one that was struck in 1951 between the Treasury and the Fed, was a signal moment in Fed independence because it got the Fed out of the business of essentially capping Treasury yields. In fact, as I like to teach my students, we all know that World War II ended in 1945, but the Fed didn't get the memo until 1951 because the Truman administration pressured the Fed to keep a cap on rates. The Fed declared independence in the accord. I think now if there is a Treasury-Fed accord, it would not be so much focused on that. It would be focused on, for example, should the Fed hold $2 trillion of mortgage-backed securities? Should the composition of the Fed's portfolio really be tilted toward T-bills and less from holding 10 and 30-year Treasuries? So I think there are a lot of conversations to have. And even during my time on the Fed, there were discussions before the pandemic about rethinking the Fed's portfolio composition. So I think that's entirely appropriate. But I think we're a long way away from any formal accord.
So what do you expect this Federal Reserve to do in calendar year 26?
Well, first we have to get the chair confirmed.
And that's not a foregone conclusion, right?
I think once he has a hearing, he will get confirmed because he's very well qualified. And but it may be a while before he has a hearing. I think it's important to note that the Powell Fed in December, when they released those dots, those famous or infamous dots, the Powell Fed, or at least a majority of the Fed in December, thought at least one rate cut this year would be appropriate. And I think 8 folks thought maybe 2 rate cuts would be appropriate. So I do think that when Warsh gets in, if the economic data play out the way that I and others expect, I think he'll be able to persuade the committee to continue to cut rates down to around 3%.
Okay.
Richard Clarida with us, folks, the former vice chairman of the Fed, hugely visible, does a great job helping us on the Fed Day. The Fed decides. Thrilled he could be in studio with us for you across the nation and around the world. Thank you for your attendance on YouTube. Subscribe to Bloomberg podcasts. I look at all this. I look at the parlor game, and just what it comes down to is staggering from meeting. when Mr. Warsh joins, do we have a theory of monetary policy, or is it every president and governor for themselves?
Tom, fantastic question, because I do think that based upon what Kevin has said with his very voluminous paper trail over the last 15 years, I think that will be a discussion. I think Kevin has expressed some skepticism for reliance on what he believes are flawed models, too much of a backward-looking approach. What I would point out, at least during my 4 years, is the Powell Fed, and certainly the Clarida vice chair, was not handcuffed to the models, even though I developed many of them.
I give you great credit. Paul, can I editorialize?
Sure,
I give you great credit for this. You're the one person who could have said we go for the models.
Well, and in fact, my first speech in October of 2018, I basically made the case that the economy appeared to have stronger growth potential and a potential for lower unemployment than the Fed models thought, and that the Powell Fed should be willing, if the labor market was continuing to blossom and inflation didn't appear, to allow that to happen. In fact, I think I said, monetary policy is not a problem if too many people are working, right? And indeed, the Powell Fed cut rates in 2019 with an unemployment rate at a 50-year low. So I think the Fed has probably been less handcuffed to models than Kevin's remarks might suggest. But I certainly think, based upon that, there will be a discussion of the best way to incorporate modeling into Fed analysis.
What happens to Jay Powell when he does step down from the Fed? Does he stay at the Fed? Does he leave? Typically, they ride off into the sunset, right?
They do. In fact, there's only one example in Fed history of a chair that did not ride off into the sunset, and a very important Fed chair, a gentleman named Marino Eccles. So important, he has a building named after him.
There you go. Okay.
And Eccles was an FDR appointee. And when Harry Truman came in, Harry Truman wanted a different Fed chair. But Eccles stayed on for 4 years as governor, and actually turned out to be a real thorn in Harry Truman's side. But fast forward to Powell. Jay Powell's been asked many times, including at the most recent press conference, what his intentions are when his term as chair is up, and he's really not commented. So there's the possibility he could stay on. I myself think that it's unlikely that he stays on for the remainder of his term, which goes through 2028.
Richard Clarida, with this, so we did a Bloomberg function. It was great. Michael McKee organized it. It was all these worthies in the audience. Yeah. Catherine Mann comes up and gives me a hug, the Queen of Dissent, over at the Bank of England. What's wrong with us being like the Bank of England and they come out like a Supreme Court decision? Oh, no, it's a Fed meeting, 5-4, and the chairman voted against the majority. Is that a bad thing?
I don't think it's a bad thing. I think the Bank of England, really beginning under Mervyn King's tenure, actually viewed it as a feature, not a bug, to have close votes, encourage thoughtful dissent. And as I recall, the governor has been on losing side on some votes there. Unusual in Fed history. In fact, to prepare for your show, I went back and looked. St. Louis Fed has a great database on this. And you'd have to go back to 1939, the last time a chair actually lost an FOMC vote, and that was Marino Eccles. But G. William Miller and Paul Volcker lost votes on discount rate adjustments. But again, we're going back 40, 50 years.
Did you hear what he said? Do you prepare for this show?
Oh, of course.
Are you kidding me?
You'd be the only one.
Richard, what's the Fed focusing on now? Is it the labor market? Is it inflation? Where's the balance these days?
They've been pretty consistent for a while that inflation's too high. It's been above target for 5 years. It'll probably be above target this year for 6 years. But the Fed has a dual mandate, and the unemployment rate is basically right now at a point that they think is consistent with a healthy labor market. But they are noticing that payroll employment gains have been very modest. Indeed, when we get the revisions later this week, it actually may show negative payroll gains in the second half of the year. And so I do think that I take them at their word when they say they would not welcome any additional rise in the unemployment rate. And I think they would react to that. But so long as the economy sort of churns along as people expect, I think they are trying to balance that against their concerns about elevated inflation.
Paul Sweeney with Richard Clarida. Right now, can I ask, can we go nerd right now?
Yeah, absolutely.
On a Monday, a freezing Monday. Okay, did you recruit Woodford to Columbia? Was that your triumph?
I was not chair when Mike was recruited. But I certainly was enthusiastic and worked hard on getting him to Columbia, which was a huge appointment for Columbia now 22 years ago. Yeah.
Michael Woodford, folks, it's a 1,000-page book. Everybody owns it. Martin Feldstein once said, Tom, no one's ever read it cover to cover. Clarida has.
I have. Yeah.
But the bottom line, and I'm bringing this up, folks, because we had an Ezra Prasad the other day from Cornell with his wonderful, important book out. The Doom Loop. A really important book.
Yeah.
And the bottom line is we assume Woodford-like Euler equations, so they come down to a point of stability. And within a system, there's stability. The end result is stability. And Professor Prasad is saying, no, it's not. They're going to go out on the x-axis and be unstable. Discuss.
Well, okay. I think at a 30,000-foot level in 30 seconds, all macro models, or almost all macro models, really are best thought of as approximations. Typically linear in a neighborhood of where you want to be. And the real world can be a lot messier and very nonlinear, a term that I know pops up on this show. And I think as I've just beginning to read his book, what he's been highlighting is we could be in a prolonged period of very nonlinear market and economic developments.
And geopolitical developments as well. So if you're halfway through the book, he sold the movie rights.
Exactly.
DiCaprio's playing. I mean, it's a gloomy book. It's shockingly gloomy.
Yeah. I've not worked through it, but certainly a must read for me. So I'll wait till I finish it before I weigh in on that.
Fair.
Hey, Richard, we're 13 months into this whole tariff thing. I'm going to look back on it and say, boy, this was nothing. It didn't seem to be that big of an issue. And that's not what I heard early on. I heard a lot of folks saying, boy, this is going to be inflationary and so on and so forth. We just haven't seen it. So with a little bit of hindsight, what's happened?
So let me reinforce what you said. When we get the data for 2025, it may show GDP growth the same as it was in 2024, maybe down a tenth. It will likely show inflation unchanged from 2024. And so a future historian may well say what you just said, Paul, which is, what was the big deal? GDP growth didn't move. Inflation didn't move. I think a couple of things. One is that the ultimate tariffs put in place were a lot lower than the Liberation Day levels. And as Besson has emphasized, that was part of the negotiating strategy. Secondly, there's a saying in baseball, sometimes you'd rather be lucky than good. I think the other thing that happened is whatever headwind there might have been from tariffs, counterfactually, was offset by the buoyant CapEx spending, especially by the tech companies, and the fact that the stock market is very optimistic on this story. So that generates a wealth effect and an investment effect. And then thirdly, U.S. companies absorbed more of the tariff hit in somewhat reduced margins. And in the aggregate, they did have that room. Profit margins have been very healthy, and they didn't pass it through to the consumer. And again, of course, we have the IEEPA decision the Supreme Court is about to release, and that may further lead to lower adjustments. Put it this way, I think if you calculate the tariff revenue we're collecting divided by imports, it's coming in at about 10%. And Liberation Day was like 35%. So that's sort of the order of magnitude.
I got 8 other questions. I got to squeeze us in to be responsible. Orszag and Posen creating a firestorm with an idea of resilient higher rates or even driving higher rates, somewhat due to the surprise of higher wages, writing this up at the Peterson Institute. Do you at PIMCO worry about price down, yield up?
Well, we get paid to worry about it. What we do observe, at least in the Treasury market, is the fact, which is really since the last Fed rate hike, which was 2.5 years ago, 10-year Treasury yields have been in a pretty tight range, 4 3/4 at the high end, 3 3/4 at the low end. Now that you also need to note that underlying real rates, which we can see from the inflation index bond market, are much higher than they were in 2019. And so we're going to have a steeper yield curve than we did pre-pandemic, which is a good thing. I think we're going to probably have somewhat elevated volatility relative to the decade before the pandemic, in which rate volatility was suppressed through zero or negative. Remember, at one point, I think in Europe, there was like $18 trillion of negative yielding sovereign debt.
Right.
So we do pay attention to it, but we think a lot of the repricing that needed to happen because of the fiscal outlook has basically already happened and is in the price.
I'm begging, when you get through the doom loop, when I get through the doom loop, I would be honored to have you and Prasad in the same studio together.
Done.
It would be like a service to a lot of people thinking about this. His public service to the nation at the Federal Reserve System, Richard Clarida. He is Global Economic Advisor at PIMCO. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
AI I'm hating because it's bringing back all my quant nightmares. When I actually study this, like I look at kurtosis, and it's like E equals X minus mu X squared, and the Y item is lots of mu in there.
Yes.
It's very mu-y as well. Joining us now, the Queen of Greek Letters, Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. If you take your world and it's Gaussian like a bell curve, like our high school, the height of our high school class, and then you transfer it over to the oddities of log normal, or even to Taleb in Poisson, you can't use that material now, can you? Because the dispersion is stupid, right?
The duck is quacking, Tom. So, I know we've beaten this analogy to death of this duck on the surface of the lake. It looks calm. I mean, a little choppier now, but those little duck feet are even more violent underneath. When we think about dispersion, so just the difference between average single stock volatility and index level volatility, there's a reason why VIX, even though it's 18, is still sub 20. That's kind of crazy. But then go over to something like VXN, your NASDAQ vol, that spreads through the roof because we got a little zigging, but we got a lot of zagging. They tend to cancel each other out. But that average single stock move has been mind-blowing.
Where's the opportunity then right now? Monday morning, it's nuts. We had that huge up Friday, right, Paul? Remind me?
That was
like 1,000 points up, 50,000 Dow. Amy Wu Silverman, where's the opportunity now given wacko dispersion?
So I think the big question right now is we're at a crossroads. Does this dispersion continue? I can tell you everyone's piled into the dispersion trade, but the question is, do we at some point just get a lift of correlation? Everything all goes risk off at the same time, and then that duck's falling off a waterfall or something. That's the big question that hasn't happened in a long time. I think there's more nervousness that could occur.
Last 10 days, when we saw the sell-off in the tech names generally, software in particular, it felt panicky to me. It felt like something unusual. Did you see that in the options markets and the derivatives markets?
Yeah, and one big question I get now is what is IGV volatility kind of telling you since then? So I can tell you that pickup in skews, that demand for hedges has faded. So it's not like people are betting that we're going to see further downside there. You're actually seeing a decent amount of dispersion just within IGV. But the question is, how frequently will we continue to have retail save the day? That's what happened again. That's your playbook.
Is that what happened
since April 2nd? Yeah, overall,
nice.
You saw that Friday. And to be fair, they won the last few rounds. And the question is does that leg of the stool continue, or does something chop it off?
Is that an ETF phenomenon? Is it more pronounced today than it was in the past because ETFs have so much money that retail maybe has a bigger play in the market?
It's a great question. I think there's just overall democratization. There's ease in how you trade. You can trade a fractional option. You can go on your iPhone or smartphone and do it. But we're seeing a lot of flows. I spoke with our ETF team into something like VOO, which tends to be a more retail heavy ETF, just historic inflows there. And then you see them again saying, like, we believe in the AI theme. We're going to go back at it. We won that Liberation Day round. There's no reason we don't believe buy the dip continues to work.
Amy Wu Silverman with us, head of derivative strategy at RBC, a quant template over the equity market. How can people in boring 401ks use your work? You talk to fancy people with fancy Greek letters, but mere mortals, like I'm in a 201k because I'm triple leveraged all cash fund. John Tucker, are you in a 501k? Did you load the boat on NVIDIA?
No, it's done remarkably well.
Yeah, please. He
great.
undersells it, Amy.
Exactly.
But no, that doesn't mean I'm retiring. Don't panic.
But there might be a new boat down at the pier. I'm thinking,
Him?
could be.
The Hinckley picnic boat.
Yeah, I was going to say Hinckley picnic boat. Tied up to the Atlantic Highlands wharf there. Amy, how can people that are mere mortals use your work?
I can tell you they already are. So the growth in income funds, for instance, where you're long an index or you're long stocks, and then your favorite word, Tom, you're harvesting volatility, you're selling yield to collect a little bit more yield. Those are some of the biggest strategies that are growing. Folks like it, and they tend to like it even in years like 2022, where the market drew down 20%, and they like it in years where the market is up too.
But do they give up the gain? If they're harvesting a hedge, they give up the gain.
So obviously there's that risk of you're limiting upside. I think for a lot of people, it's more about that yield collection is attractive depending on where they are in their time horizon. That might make more sense. And they're okay with that, especially if they think we're getting kind of heady in terms of valuations.
Well, I would think your desk is writing a lot of business because, boy, if I were a salesperson, I could do the what if here, the AI trade is ending, and so on and so forth. You can't be out of this market. Be writing options all over the place.
It's been, I will tell you, the volume in options has been really busy. Right. I think last week in XLP, so the staples, we saw more than 1 million trade on the put side. Right. I mean, just stunning. In what you would arguably say is a boring defensive industry. It's very active. And the other thing is, there's also the Trump Twitter risk. That's my bad joke of, Twitter risk from Trump at any moment can just shift the game. Geopolitical risk. It's one reason we still think GLD vol makes sense on the upside.
Okay, very importantly, Amy Wu Silverman, folks, is our surveillance Taylor TS correspondent. Here, should Taylor do the Super Bowl?
I think she's busy planning her wedding in Newport.
Yeah,
she's transcended the Super Bowl.
I think
don't know. My husband's nursing his Patriots loss, so it hasn't been great for us, the Silverman household.
Amy Wu Silverman, thank you so much. Really, really appreciate it with RBC Capital Markets. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is the best research real estate note I've seen. Thank you, John Tucker. Rich Hill with us, Global Head of Real Estate Strategy. Your note is a breath of fresh air because it's not a monolithic note. There's all sorts of nuance in it, in that. For an investor right now, is a general statement, I need to acquire REIT shares. Does that make sense now, given the cacophony of your note?
So it does and it doesn't. So let me explain what I mean by that. REITs have been out of favor for the past several years. And I get it, right? We've been in a high growth environment. We've been in a rising interest rate environment, and that's not conducive for REITs. But you were talking about a rotation that we're seeing previously, and REITs are participating in that rotation. They're now up 5% year to date. They're the sixth best sector of the S&P 500 after being the worst sector last year. But commercial real estate is not a singular asset class. It's actually 18 different subsectors that do something very differently at different points in time. And I think that's our key view here. This is not a single sector beta trade that we're seeing for commercial real estate. We think this is a cycle for dispersion where we're seeing significant dispersion in returns across property types, markets, and even fund vehicles. We think that's a market that's ripe for alpha, but no, this is not a market where you're supposed to be just buying everything.
That was my mistake. Commercial real estate, I used to think that was just office. Now I know better. It's, it's retail. It's, it's all these other places, data centers and all that kind of stuff. Where is the value today in commercial real estate? Where are the opportunities? Where are you guys allocating capital today?
Sure. Well, we like to say themes still matter, but they require hyper focus. So what are the themes that we're talking about? I always like to start with the housing market because the housing market is everyone's favorite sector right now. You've heard this statistic thrown out all the time that the U.S. is underhoused 5 million, 7 million, 8 million homes. That's mathematically true, but it's actually the wrong discussion. It's the wrong debate. We think we have a housing mismatch in the United States. We've built too many homes of certain types in some markets and not enough homes in other types in other markets. So we actually might have a conventional Class A multifamily oversupply problem in the United States, but we haven't built enough affordable housing in the United States. We haven't built enough middle-class housing in the United States. And you can't move a house from a high-growth market in Texas to someplace in the Midwest. By the way, Chicago, Illinois, the #1 apartment market in the United States right now.
So how do we get to a place where we do have this lack of housing here? My contention is if I'm Toll Brothers or whomever, I'm building a $1 million McMansion because I've got a nice fat margin on that. I don't have the same margin building a $200,000 or $300,000 or $400,000 starter home or something like that. But that's just the economics of the marketplace. How do you change that?
Yeah, so you're absolutely right. It doesn't cost really anything less or more to do a conventional Class A versus an affordable housing. All you're talking about is the difference in the amenities. So as a result, people only buy new, pretty building commercial real estate properties and homes. It is very hard to build affordable housing without government subsidies of some sort. But I think the market's changing where we're going to do this with lower cost price points like manufactured housing, for instance.
Rich Hill, with his principal asset management, global head of real estate strategy, with a really, really nuanced note about what to do, what not to do as well. So off your note, I looked at hotels. We all know in this room, hotel prices are nuts. You go around the world, it's absolutely nuts. I look at Host, HST, which is, I guess, a fancy hotel property REIT, and it's not giving me the returns that I'm seeing in those price per nights in those luxury hotels. Why is that?
Yeah, sure. So we think there is a K-shaped recovery occurring in the U.S. economy right now. What that basically means is high-income earners are doing really well, middle-income earners are not doing as well, and low-income earners are really struggling right now. You can see that in auto delinquency rates, student delinquency rates, credit card delinquency rates. The high income portion of hotels are doing really well, and some other portions of hotels are not doing so well. So there's this real interesting mismatch going on where RevPAR, so rooms per night, the highest income cohort is accelerating while everything else is flat to slightly down.
So what are we doing here in commercial real estate? Is it all data centers? Is that where I'm putting my money? Because it seems like everybody.
Is there a data center REIT?
There's got to be an ETF or a REIT or something there.
There are data center REITs, and they've been around for almost a decade now. But we think data centers are becoming a really nuanced asset class. So maybe 10 years ago, everyone was bullishly optimistic about them. Now people have maybe turned a little bit too bearish on them. But there's 3 types of data centers. There's cloud data centers, there's AI inference data centers, and there's generative AI. Cloud is really attractive because we're using cloud right now. Cloud's been around forever. It's not going away. We actually like AI inference because when we go on ChatGPT, that uses cloud inference. Or AI inference, excuse me. Generative AI is when you're training models for future unknown AI demand. That's where a lot of the supply is coming, and that's where a lot of the spec building's coming. We're cautious on those. But we like these segments here. We don't like these segments here. The market's evolving.
Away from principal asset management, with what you've done, Conan Steers and all over the year, your work at Georgetown years ago, when you're at a Super Bowl party and somebody says to you, Rich, what do you do about the housing crisis in America? Our kids can't afford it. The average first-time home buyer now is, what, John, 72, 73, something?
Yeah, no, just about.
How do you answer this national question we have?
The first question is you have to acknowledge it. It's very real. Housing pressure for a lot of people across the United States is very, very high. What do I think you have to do? Well, the easy answer to say government, public-private partnerships, that's probably easier said than done. I think what we need to do is take a cue from the manufactured housing market. So that's markets that's formerly known as mobile homes, where you're building really nice homes with relatively cheap or inexpensive products. I think if we can find a way to use manufactured homes technology, for a lack of a better term, and go vertical with it, that would be a long way to solve the affordable housing crisis in the United States.
Office real estate, New York City, where are we today?
Yeah. So I like to tell people that the leading indicator for a rebound in the office market is what is happening in the debt markets. The commercial mortgage-backed security market, so CMBS, boomed for New York City office in 2025, and it's off to a pretty good start in 2026. commercial mortgage lending was back to historical averages for office. The market likes gateway coastal markets like New York City and San Francisco right now. We actually might have already missed the bottom in San Francisco. It's back that much. So this is a market of have and have-nots. We don't have an office problem in the United States. We have a Class B and C office problem. Okay. That's too many office buildings built in the 1970s and 1980s that didn't put any CapEx into them over the past several decades. No one wants those buildings. New properties, they're great. The challenge is we have 90% of office vacancy focused on 35%.
We got to go. Do you bulldoze those properties?
You do. Because it's actually just as expensive to rebuild as it is to.
Are you based in New York? I don't even know.
Yeah, I work just a couple blocks down.
You don't want to say that because we'll call you every third day.
I am always happy to come back.
Oh, Tom, it's such a drive. It was so hard to get here. This is fabulous. Rich Hill, don't be a stranger with Principal Asset Management. Rich Hill, Global Head of Real Estate Strategy. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm going to go somewhere where I'm curious, and I really don't think it's front and center, but Lindsay Newman's going to brief us here. Absolutely phenomenal geopolitical risk expert at GZero Media at King's College London. Iran. Dr. Newman, I guess there's this idea of X number of our fleet in the vicinity of Iran. How do you interpret the movement reports of U.S. military assets in the Middle East?
Hi, Tom. Morning. Yes. Well, how we interpret this is to say that no surprise here, the Trump administration is pulling all levers simultaneously. So just at the end of last week, of course, there were these indirect bilateral talks between the U.S. and Iran. We also saw simultaneously, not well reported, that the administration issued a new executive order assessing the threat of Iran and extending the national emergency that Iran poses to America in order to open the door for more secondary tariffs. So this is the key economic leverage piece that we expect that the administration will pursue. And then, of course, this time around, the second Trump administration, it's also all about force and force posturing. So we know, as you've said, that the administration has moved a massive amount of kit into the area. It includes a strike carrier force. It also includes naval destroyers, some other aircraft, as well as anti-aircraft defense systems, which will be critical in the event that the U.S. decides to pursue some military action in Iran, and Iran decides, of course, to retaliate against U.S. assets in the region or more adventurism in the region.
Dr. Newman, what type of agreement is the U.S. pushing for?
Yeah, I mean, this is the big question, Paul, right? Because last week we saw that talks were scheduled to go ahead in Turkey and they were going to be multilateral. And then the talks were called off. And then they were rescued to be relocated in Oman, and they were indirect bilateral talks, as I said. And the sort of back and forth, even on the location, shows that these two sides are not in alignment. They're not in alignment about where they're willing to talk, who they're willing to have in the room, and they're certainly not in alignment about what they're even talking about. Iran has been very clear that the conversation is only about its nuclear capabilities. It's not even about enrichment. It's only about reassurances that their nuclear capabilities are for non-military purposes. But the U.S. has been very clear, and this was again stated last week by Secretary of State Rubio, also in the executive order, to say that the conversation the U.S. is intending to have is about all nuclear capabilities. There cannot be a nuclear Iran. It's also about ballistic missiles. It's also about Iran's regional proxy support, and even a bit more about what's going on at home in Iran. So the two sides do not have the same level of items on the table. And that means that any so-called deal that can be reached feels very sort of out of frame.
What is the current nuclear capabilities of Iran right now?
I mean, I think it's anyone's guess, Paul. I mean, we know that over the last several years, there was the Operation Midnight Hammer, where the U.S. pursued strike action against 3 nuclear facilities in Iran, following Israeli also action against the facilities. But we know that sort of inspectors have not been allowed in of late. Estimates are that those strikes last year definitely degraded some enrichment capabilities, but it's really a sort of black box issue.
Lindsay Newman with us, geopolitical risk expert at GZero Media, with all of the abilities of King's College London. They have been definitive on the study of conflict and war. Lindsay, I'm absolutely, and I say this with immense respect, did you watch the Super Bowl or the beginning of the Super Bowl from London, Dr. Newman?
I didn't watch the beginning, but I will tell you that my sons insisted on watching it this morning. So we watched it at 6 a.m. in the replay.
Right.
I didn't get a chance to watch the halftime show. I'm very intrigued to watch it, but my day has not allowed yet for me to watch the halftime show. I did see it was resplendent, and people seem excited about it.
We'll expect a report from GZero Media on Bad Benet and Dr. Newman. All kidding aside, Dr. Newman, we have a method in America of showing the flag, showing the military. We have a Budweiser commercial with an eagle coming off the back of the horse. And it's obligatory that at these big events, 6 or 7 fancy military aircraft fly over in that. Okay, all that's fine, but we have to deploy our resources to the Pacific, deploy our resources to the Middle East. A pro like you, how do you respond to Americans that are comfortable about 5 airplanes flying over a football stadium, but are we ready to offense and defense in the Middle East?
Yeah, Tom, I mean, we know the polling shows that 70% of Americans are not in support of this idea of seeing the U.S. engaged in military action in Iran, whether it's in support of the protesters, the thousands that died and those still left in Iran, or if it's even about Iran's nuclear capabilities. Those are stark numbers, right? So only 30%, less than a third of Americans really want to see the U.S. engaged in military action. And that's because we know there's a long history of getting involved in forever wars. As you raised with me the last time, Lawrence Friedman has talked about this recently, this idea of the fallacy of a short war, that there could be some, ambition that it would be surgical and focused, but you can't control what the other side does once you take any sort of action. So Americans have been clear that they don't really want to see the U.S. involved in ongoing conflicts like that. But the Trump administration has been clear that it's going to apply all forms of pressure.
What do you think Iran wants at this point in these negotiations?
Well, Iran wants to see some sort of negotiation to negotiate continue. We know last year there were 5 rounds of negotiations that then the administration in the U.S. said, well, we're not reaching a deal, so we're going to pursue force. Iran just wants to see de-escalation and punt this whole latest blip in the escalatory cycle down the road, because it hopes that it can sort of lead to just an ongoing, more permanent de-escalation. I think that that's a hard scenario to imagine happening. I think that the U.S. has been pretty clear in saying, if you're a U.S. citizen in Iran, get out or otherwise stockpile. That's a very stark indicator to watch for. But Iran is certainly hoping that it can convince the U.S. administration to just keep talking.
Lindsay, thank you so much. Lindsay Newman with us today, geopolitical risk expert, GZero Media at King's College in London.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.